Hi everyone, this is Rajiv Vidani. I'm a partner with the banking and finance team of Khaitan and Company. I'm joined with my colleague Abhimanyu Bhattacharya, who's a partner with capital markets team of the firm. We would like to welcome all of you to this short webinar on InvITs. As we all know that how life and business has been disrupted due to the current affairs as we know, we thought that this is a good opportunity for us to invest in our learning and development initiatives. And as part of this learning and development initiative, we thought that InvIT would be an interesting topic for us to share our thoughts and experiences with our clients in the banking industry, considering the investment avenue InvITs offer, and also because of its importance in the infrastructure sector, as well as uh, the recent RBI circular in 2019 October, which allowed banks to lend to InvITs. InvITs, as we know, it's a nascent regime, and there are not too many InvITs in India. However, I would now transfer the mic to Abhimanyu, who has significant experience and who has dealt with some of the recent couple of InvITs in India in some capacity or the other. He has advised there. So over to you, Abhimanyu.
Thank you, Rajiv. Firstly, thank you to everyone for joining our webinar. It's a great pleasure to be with you this afternoon. I hope all of you are safe and well at this time, and I hope and pray to come out of this situation sooner rather than later. Coming back to our topic for the day, we are going to talk about the InvIT regime, provide you with an overview as to the manner in which the InvIT regime has been set up by the regulator and by other stakeholders, some of the more recent developments that have taken place in this space, and some of the future developments as well, and all the way how this space is going to evolve. Moving on to our first slide in terms of opportunity, the InvIT opportunity. SEBI notified the InvIT regulations in 2014. The work to put together the InvIT regulations actually started with the REIT regulations. A lot of focus was actually spent by the regulator and the stakeholders on the REIT regulations, and the InvIT regulations is actually an afterthought that came. But in the manner in which it has worked in the Indian market is that we've seen few more InvITs than REITs. So from a InvIT opportunity perspective, an InvIT is an innovative vehicle to finance capital-intensive infrastructure. If you look at the structure of an InvIT, it essentially has benefits to both the infrastructure providers and the infrastructure space investors. For the infrastructure providers or for the sponsors, it is a viable financing option for development or for monetizing their assets. Once you set up an InvIT regime, it provides a liquid platform for owners of infra assets or operators of infra assets to monetize them by transferring them in an extremely tax efficient manner to an InvIT, to a trust which is registered with SEBI as an InvIT. From an investor perspective, it provides the opportunity for investors to invest in a capital intensive infrastructure in a liquid fashion. Given the manner in which the regime has evolved, given the manner in which SEBI has specified the various governance structures in the InvIT regulation, it provides an extremely transparent method of asset management. The structure, if you see, and we'll address that in the slides to come, is akin to a mutual fund structure, where you have a trust, where you have an investment manager, where you have a sponsor. Of course, there are certain other additions within the InvIT framework, but at its very root and its very core, the regulator took a leaf out of the mutual fund playbook and used it here. And finally, what we expect to see is that the InvIT will become a high-yield product in the future, though may not be giving those yields at the moment, but it has the potential to become a liquid high-yield structure with scope for capital appreciation. Let us now move over to the InvIT structure slide that you have before you, and I will give you an opportunity to walk you through the important constituents of the InvIT structure, and we'll discuss about some of the eligibility requirements as well. At the very heart of the InvIT structure is, of course, the InvIT itself. The InvIT is set up under the Indian Trust Act of 1882 by the sponsor. The sponsor in this case essentially is the owner of the asset traditionally. We'll address a couple of examples that we've now seen where the sponsor has not been the asset owner. Those structures are what we call white label InvITs. I'll touch upon them in a short while. So the sponsor contributes, essentially the sponsor, the owner of the asset contributes the asset to the InvIT, right? Now, from an InvIT perspective, the process essentially kicks off when the sponsor makes a registration application with the regulator. The sponsor sets up the trust as a settlor of the trust. The sponsor then applies to SEBI for the trust to be registered as an InvIT. At that point in time, certain other constituents also have to be finalized. The first important constituent is the trustee. The trustee holds the InvIT assets in trust for the beneficiaries of the trust, which will essentially be the unit holders after the offer has been made. The other important constituent, and the constituent that will essentially operate the InvIT on a day-to-day basis, is an investment manager. The trust enters into an investment management agreement with the investment manager, who is responsible for the day-to-day operations of the InvIT. The InvIT holds the assets. The assets are largely held through SPVs, which have been transferred by the asset owner or the sponsor to the InvIT. And the SPV and the regulations stipulate that the SPV can only hold the relevant infra assets or take business activity which are ancillary to those assets and can take on no other activity. The other important actor in this structure is essentially the valuer. The valuer is very critical to this entire structure because at the initial stage, the valuation is critical to ascribe the value to the units. And in a publicly offered InvIT scenario, the valuation happens on a 6-monthly basis. So that gives the unit holder the relevant guidance and the market the relevant guidance as to how the unit should be valued and priced. The other important constituent and the final constituent that is there on the slide essentially is the project manager. The project manager is responsible for the day-to-day routine operation and maintenance of the InvIT assets. So essentially, the project manager is usually maybe an affiliate entity of the sponsor, which has been operating the asset till the time it's actually moved to the InvIT, and the project manager continues to operate that asset even after transfer to the InvIT. And there are relevant agreements that are executed between the investment manager, sponsor, and the project manager for the project manager to continue the O&M of the InvIT assets. So essentially, that is the manner in which the InvIT structure has been built up. Certain important features of an InvIT, which I would like to point out at this stage. The first critical feature is that there can be no multiple classes of units. The regulator in the regulations has specifically prohibited multiple classes of units. The regulator has prohibited any superior voting rights being ascribed to any unit holder. However, the sponsor, if it so chooses, can take units which have lower voting rights or subordinate units. Possibly this was put in place by the regulator to make a structure more commercially attractive, but the sponsor actually takes a lesser economic benefit than compared to the other unit holders. An InvIT cannot invest in units of another InvIT. So you can't have InvIT A investing in the units of InvIT B. So that is something that is clearly prohibited by the regulation. The regulations also prohibit schemes under an InvIT. And the regulations also prohibit from an InvIT from lending to third parties, this does not mean that an InvIT cannot invest in debt securities. We'll come to that later under investment conditions. But plain vanilla lending to third parties by an InvIT is prohibited. Let's move over and see the eligibility conditions of some of these constituents. The first one is the sponsor. The regulations stipulate that the minimum net worth in case of a company or net tangible assets, if it's an LLP, is at least 100 crores. There's a track record requirement, as you can see, of infrastructure development and fund management for a period of at least 5 years. The sponsor is also required to hold a minimum of 15% of units after the offer. And this 15% is required to be held for a period of at least 3 years and the balance for a period of 1 year. So if you know our regular equity structure for initial public offers, etc., you will recall that there is a concept of promoter contribution, where promoters are required to hold at least 20% of post IPO capital, and the balance is required to be held for a period of 1 year. So this is something similar, where the sponsor is required to hold a minimum of 15% in this case post offer, and the balance for a period of one year. Moving over to the next constituent, the eligibility requirement for the trustee. The eligibility requirement for the trustee essentially is that it has to be a registered debenture trustee and cannot have any association with the sponsor or the investment manager. So you have a number of trustees who are already operating in the debt market, such as Access Trustee, etc. Right? So usually these are the trustee companies that you will find in the in an InvIT structure. The next criteria is for the project manager. The project manager essentially has to be a fit and proper criteria holder as per the SEBI requirements. The project manager essentially, does not undertake any investment decision work. As I said, it's essentially a operating and maintenance company, typically an affiliate of the sponsor. So to that extent, it has a very simple eligibility criteria requirements. It has to be fit and proper SEBI requirements. The next eligibility criteria is for the investment manager. The investment manager, again, you need to have a minimum net worth requirement if you're a company, or a net tangible asset requirement if you're an LLP is of at least 10 crores. Again, from a track record perspective, investment manager should have infrastructure development, fund management, or advisory experience of greater than 5 years. Very recently, SEBI has permitted that in the event that the entity itself does not meet its eligibility requirements, the combined experience of at least 30 years of directors, partners, or employees of the investment manager is also possible to meet the eligibility criteria. But the persons whose experience is being aggregated should have at least 5 years experience in either infra development, fund management, or advisory. The important, again, governance point from an investment manager perspective is that the board of directors, the governing board, should at least be 50% independent. So in most cases, the investment manager, if you would have seen the InvITs that have taken place in the market, has some affiliation to the sponsor, and that's okay, as long as you ensure that 50% of the IM board is independent. So let's move on to the next slide in terms of where and what the InvITs can invest. So the Ministry of Finance has a circular dated October 2013, which specifies the eligible infrastructure sectors. So the SEBI regulations indicate that InvITs can only invest in the sectors identified in this circular specified by the MF. So under this circular, you have 5 broad heads and various subheads. I will just touch upon the 5 broad heads here, and you have that on the slide as well. You have water and sanitation, you have communication, you have social and commercial infrastructure, you have transport and logistics, and you have energy. So these are the 5 main heads of infrastructure investment that InvITs are permitted to do. InvITs cannot invest, as you know, in real estate, because that will in some form overlap with the REIT regime. So from that extent, InvITs cannot invest in real estate to that extent. Now, from a investment threshold perspective, what the regulations require is that if you are a publicly offered InvIT, you're a listed InvIT, then 80% of the InvIT assets have to be invested in income generating assets. If you're a privately placed listed InvIT, then it has to be an eligible infrastructure project. An eligible infrastructure project need not necessarily be one that is generating an income, but as long as you have approvals for construction of the project, that is good enough. The minimum threshold when you're making an offer is that whether it's a private placement or whether it's a public offer, is that you have to have an asset value, InvIT asset value of at least 500 crores and a minimum offer size of 250 crores. And one of the critical requirements, and I'll spend a couple of minutes on this point, is that the regulations stipulate that the InvIT needs to have control of the InvIT asset, which is usually held through SPV. So essentially, control of the SPV is critical to the InvIT structure. But as you know, in PPP projects, in certain cases, the sponsor is not permitted to transfer the or permitted to, continues to hold a particular percentage in the asset SPV, or the InvIT may not be in a position to hold 51% in at least 51% in the asset SPV. In such cases, given that it's a requirement under the relevant concession agreement, and to that extent a regulatory requirement, the InvIT regulations permit that a shareholders agreement needs to be executed between the shareholders of that SPV and the trust, where the shareholders agree that at no point in time will they hinder or obstruct the working of the InvIT in the manner required under the InvIT regulations. The balance 20% of InvIT assets can be invested in under construction infra projects, but even there is a cap of 10%. You cannot exceed 10% of InvIT asset value for under construction projects. You can also invest in listed and unlisted debt of infrastructure companies, equity of listed companies that have at least 80% arising from income arising from infrastructure. And then finally, you have GSECs, you have mutual funds and securities of that nature, where the InvIT can invest its balance funds. Moving over to the next slide, we will talk a little bit about the InvIT distribution, and my colleague later, Rajiv, will talk about the borrowing structure. To touch upon InvIT distribution structure, there's a concept which has been introduced in the SEBI regulations called net distributable cash flow, or NDCF. The InvIT regulations require that the cash flow from the SPV to the InvIT and from the InvIT to the unit holders, at least 90% of net distributable cash flow has to be upstream at both these levels, right? The minimum frequency of upstreaming the cash is half yearly for InvITs which have been listed on a public offer basis, and for InvITs which have listed on an annual basis, or for unlisted InvITs, it is annual. So the NDCF methodology, or the formula for calculation of NDCF, has also been prescribed by SEBI. It has to be disclosed in the offer document, which is required for any offer, whether it be a public offer, private placement, or even for even an unlisted scenario. The calculation methodology essentially is that you take the profit after tax and you add non-cash items such as depreciation, amortization. Then you deduct any form of liability which you have towards repayment of external debt or redemption of debentures, and you arrive at the NDCF number. This is of course a simplified version for the purpose of this presentation. The SEBI, the formula has certain other things, such as when InvIT sells an asset but does not distribute it further to the investors. So there are certain other nuances, but on the whole, the NDCF formula is what you have before you on the slide. So I will now hand over to my colleague Rajiv on InvIT borrowings, and he'll walk you through for some of the more recent changes that SEBI has introduced in the borrowing regime for InvITs. Rajiv, over to you. Rajiv?
Thank you, Abhimanyu. Can we move to the next slide? So as far as InvIT borrowings are concerned, while the SEBI InvIT regulations permitted InvITs to borrow at the time of issuance of the regulations, however, bank funding is something which has been recently allowed by the RBI by way of its clarification, which RBI issued on 14th October and laid down certain conditions subject to which banks can lend to InvITs. Generally, in terms of InvIT borrowings, there are three thresholds which have been prescribed for InvITs to borrow money from third parties. The first one being is a 25% threshold. So as long as you are borrowing within the 25% borrowing limits, and this 25% borrowing limit is a consolidated limit of the InvIT, the SPVs, and the holdco. There is no credit rating required, and there is no approval required from the unit holders. So the investment manager can decide whether it wants to borrow from any third parties. If you want to exceed beyond 25% to up to 49%, there is a requirement of obtaining a credit rating, and also there is a requirement of obtaining approval from 75% of the unit holders. However, if you wish to borrow from 49% to 70%, and the overall cap of borrowing for an InvIT is 70%, there is a credit rating requirement of AAA. Also, there is a requirement of obtaining approval from 75% of the holder. There is also a requirement that the funds can be used only for the purposes of acquisition and development of the assets. Also, there is a requirement that it should not in toto exceed 70%. As far as the bank funding for InvITs is concerned, there are certain restrictions which RBI has placed, which are to be complied with at the time of borrowing. The first one is there should be a board-approved policy of the bank, which should cover aspects inter alia appraisal process, sanction conditions, internal limits, monitoring mechanism. There should also be a check that there should be enough debt service cover at the trust level itself. The consolidated leverage of InvIT should also be within the permissible limits as mentioned. There should also be a requirement of there being a regular performance monitoring of all the underlying SPVs. There is a requirement that none of the SPVs should be under financial difficulty. The definition of financial difficulty and its indicators are set out in RBI Prudential Framework for Stressed Assets dated 7 June 2019. There is also a condition then that the lending for the SPV, as far as the financing of equity is concerned, it should be subject to the same restrictions which are set out in the RBI Master Circular on Loans and Advances, 1st July 2015, where in paragraph number 2.3.7.4, it mentions the restrictions on promoter equity financing on the banks. The same restrictions are applicable here as well. There is also a requirement of bank audit committee to review a 6-monthly compliance. That is, every 6 months the bank needs to check compliances with all the conditions as well as their monitoring of the financing. Apart from bank borrowing, as already mentioned, InvITs can also issue debt securities. Regulation 20 of the InvIT regulations prescribe that a listed InvIT can also issue debt securities which are to be listed on a recognized stock exchange. In addition, the compliances will be required to be made pursuant to Companies Act 2013, and however, the filing requirements which are required as per ROC are not applicable here, considering that this is a trust which will be issuing the NCDs. The debenture trustee which has to be appointed, it has to be ensured that it is not the same trustee which has been appointed as the trustee for the trust. There has to be an adequate security cover as required under the Act. There is also requirement in terms of compliances and also in terms of compliances which are to be submitted to the stock exchange as well as in the audit reports. So overall, InvITs as of now, on the basis of the recent amendments to the SEBI ILDS regulations as well as the circular which has been issued by the Reserve Bank of India, InvITs now have access to bank borrowings in India as well as to ECBs from overseas, and by issuance of debt securities to foreign investors as well as domestic investors. I will hand over the presentation back to Abhimanyu.
Thank you very much, Rajiv. The next topic that we want to talk about essentially is to walk you through the various fundraising, the three important fundraising methods for InvITs. Right. So if you see on your screen, you'll see that the way we have done this is that we've categorized it into fundraising by a public InvIT, a listed private InvIT, and an unlisted private InvIT. So essentially, the regulations now very recently permitted InvITs to be also issued on a private placement basis, and you don't need to list the units. When the InvIT regulations were first introduced, an InvIT could take place only in two forms. One is through a public InvIT and one is through a private placement. And in both cases, you had to list the units. But there were certain stakeholders who believed that InvIT should also have the flexibility of not listing them. And that was debated for a long time. And finally, last year, was the end of last year, SEBI actually permitted unlisted InvITs to come into play. But the difference was that when unlisted InvITs were finally notified in the regulation, the tax benefits were not extended to them. At that time, it was essentially a structure that was dead in the water, because at the end of the day, and as we'll see later, the InvIT regime is essentially a tax efficient regime. And if the tax benefits are not extended to an InvIT, then it's of practically no use. So from that perspective, the tax benefits which are available to listed InvITs have also now been extended to unlisted InvITs, which has made that a fairly important solution for some of the sponsor stakeholders who are looking at InvITs quite closely. And we believe that we may see, as and when the market conditions improve, and we were actually, before this crisis happened, we're actually in talks with some of our clients who are looking at unlisted private InvITs fairly closely. In fact, a couple of clients wanted to move over when they were discussing a listed private InvIT structure to an unlisted private InvIT structure. So there are certain benefits to moving to an unlisted private InvIT structure, and we'll go through those. So if you see from a public InvIT structure, essentially it's a public offer, just as you would have for a company, right? So from that perspective, you have an offer document, which is a prospectus, and you have to follow. There is a detailed guideline prescribed by SEBI as to the manner in which a public offer has to be executed. And it's for those who are well versed with the equity capital markets process in terms of IPOs. You will not find it very different. In terms of a minimum number of investors, a public InvIT has minimum requirement of 20 investors who are not related parties or sponsor or the sponsor. Of course, being a public offered InvIT, there are no maximum investors in play. And the minimum investment, which was also actually reduced way back in 2018, it used to be 10 lakhs. The minimum investment was reduced to 1 lakh. And the maximum investment per investor was essentially not more than 25% of the offer size. The trading lot, etc., is of course of 100 units. All of these were actually reduced way back in 2018 because public InvIT markets were not taking off, and the stakeholders said that the trading lot, the minimum investment limits are very high. So to make that a little bit more palatable, these changes were made at that time. The eligible investors essentially our QIBs, FPIs, family trusts. These are all institutional investors who have net worth of more than 500 crores. We've already touched upon the distributions, the distribution frequency from the public offered InvIT. As I said, it's twice a year. The valuation of assets, again, because it's a publicly offered InvIT, also needs to happen again on a half-yearly and annual basis. From a minimum public offer perspective, again, very similar to Indian IPOs, right? If you need to offer at least 25% if your post IPO unit capital is going to be less than INR 1600 crores, and if it's more than 4,000 crores, then you can do a minimum valuation of 10%. If it's between 4,000 to 1,600, then you can do a valuation between 25%, between 10% and 25%. And if you are lower than 25% on completion of your listing, you need to ensure that you reach the 25% limit within a period of 3 years. Moving over to a listed private InvIT. Again, listed private InvIT, then you have a minimum requirement of 5 investors who are not your sponsors or related parties, and you can have a maximum of 1,000 investors. Now, from a minimum investment perspective, minimum investment is 1 CR, but if that privately listed InvIT has invested more than 80% in completed and revenue generating projects, and completed and revenue generating projects are those projects which have achieved COD, which have received all approvals, which have been generating revenue for a period of 1 year. If the private listed InvIT has more than 80% or more of its investments in such assets, then the minimum investment size is INR 25 crores. Again, from a maximum investment perspective, no one investor can invest more than 25% of the offer size. Again, from a listed private perspective, you have institutional investors who are QIBs, body corporates, family trusts, and registered and SEBI-registered intermediaries, which have net worth of more than 500 crores. Again, though it's a privately listed InvIT, and the dilution levels which are specified for a public offer are supposedly also required to be met by the privately listed InvITs as well. Though we have not yet seen the privately listed InvITs actually execute this, and that's something I think maybe they're discussing with SEBI at this point. But as the law stands today, the public offer dilution thresholds also apply to listed private InvITs. From an unlisted private InvIT perspective, and we've not yet seen an unlisted private InvIT, there are actually only 2 publicly listed InvITs in the Indian market today. The first is the IRB one, the second is IndiGrid, which is a sterilite transmission asset. After that, all other InvITs have actually been listed private InvITs, which essentially the L&T, the Brookfield gas pipeline. Then there are a couple of others which are also in play. We may see that they may convert to a unlisted private InvIT. That's at least what the news in the market is. So from an unlisted private InvIT perspective, we see that there are no minimum investors, and that is as per the discretion of the InvIT. But it has, again, a maximum investor limit of 20. From an investment threshold perspective, it's a minimum ticket size of INR 1 CR. Again, no maximum investment limits have been prescribed. The unique thing about, again, an unlisted private InvIT is that leverage limits are open to be decided by the sponsor, and that would be prescribed in the trust deed. Eligible investors largely remain the same, essentially institutional investors. The distribution frequency of cash, again, is on an annual basis, and there is, of course, being unlisted, no minimum public offer thresholds. So that, in a nutshell, essentially are the modes in which an InvIT can access the market for the first time. SEBI has very recently introduced methods for a preferential allotment, for a institutional placement, and for a rights issue as well. And in all of these modes, they are very similar to what you would see for a listed company. And the modes are very similar to the modes that are prescribed by for listed companies under ICDR regulations, whether it's pref allotment, whether it's a QIP, or even a rights issue, including a fast track rights issue. So moving over to the next slide, we'll touch upon a little bit about the governance structure that is prevalent within the InvIT regime. And this is fairly critical because this is essentially what is the linchpin which regulates the manner in which the investment managers will also have to manage the InvIT. So the governance matters are prescribed under three buckets. There are matters which require essentially disclosure to the unit holders and the exchanges. There are matters which require a simple majority, and there are matters which require at least 2/3 of the votes to be in favor of that decision. So certain critical things need at least 2/3 of the votes, and in certain cases also approval from the regulator, which is essentially a change or removal of the investment manager. Change in control of the investment manager, any extraordinary issue which warrants approval reform from the sponsor IM or trustee, right? If there is a delisting of units, if there's a material change in investment strategy, if there is a proposal to purchase any project at 110% of the fair market value or sale below 90% of the fair market value, these are topics which require at least 2/3 votes coming in from the unit holders for the investment manager to execute any of these decisions. The matters which require a simple majority vote, as you will see, are matters that are largely things which you would expect to be in the course of the InvIT's regular working life. For example, transactions which can exceed 25% of the InvIT value requires a simple majority approval. As Rajiv mentioned, in terms of borrowings, if you're exceeding borrowings of between 25% to 49%, you will need a 50% unit holder approval. Again, if you go beyond 49%, you need 75% unit holder approval. Then there is, as I mentioned before, there are investment thresholds, 80% in infrastructure assets, 20% in other assets. At any point in time, if these thresholds are breached, the regulations stipulate that you have 6 months to bring it back. In case an InvIT requires more time, in case it requires additional time, more than 6 months, then it has to go back to the unit holders for an approval, for a simple majority approval. Again, related party transactions which exceed 5% of the InvIT assets value, including borrowings, so related parties need unit holder approval. So matters which require essentially a disclosure to the exchanges, again, are far more routine in nature. Essentially, when you're acquiring or disposing any projects which are greater than 5% of InvIT asset value, if there's a change in credit rating, if there are material legal proceedings, if there are fresh issuance of units, matters of this nature or any other item from a disclosure perspective which is considered material, very similar to the standard that we apply for listed companies. If matters such as those come to pass, then an InvIT is required to inform the unit holders through the stock exchange mechanism. So this essentially is the governance structure which the regulator has put forward. Essentially, the point being is that InvIT is largely free to run its activities, but where there are decisions to be taken which may impact the InvIT on a critical basis, whether it's the constituent like the investment manager, or whether where you are exceeding leverage limits beyond a particular threshold, only in those instances are you required to go back to the unit holder. But again, the governance structure is fairly robust, and a lot of the governance structure is also imbibed in the investment management agreement, which is reviewed and by SEBI at the time of SEBI registration. So again, from a transparent management of asset perspective, the governance structure for InvIT gives you the wherewithal to the investment manager and the unit holders to manage these infrastructure assets on a fairly transparent basis. Quickly, we'll move on to the next slide, and we'll just have a quick look on what an InvIT offer document looks like. Again, those of us who are familiar with offer documents or various offerings, the there's not a massive difference between a offer document for a public offering for a company as that of an InvIT. There's certain important distinctions, and I'll touch those first. Essentially, are projections. Now, the InvIT model, as you know, essentially is a projection model, and the disclosure requirements are that you have to give projections for on an asset basis for a period of 3 years. And this projections will have to be included, of course, in the offer document, and that has to be supported also by the valuation report, which is issued by the independent valuer. An InvIT valuer can hold his position for a period of 4 years. After that, there is a cool-off period for 2 years before that valuer can again come back and perform the valuation of assets for that particular InvIT. From a financial statements perspective, again, audited IND-AS financials for the last 3 years and the stub period. The other important aspect is that you need audited financial statements for the investment manager and sponsor also to be included for the last 3 financial statements. There is also a concept of combined financials. The combined financial essentially is that you're supposed to also present, it's actually more akin to a pro forma, if you can say that. A combined financial essentially takes the trust financials and the financials of each of the assets that are coming into the trust and presents that on a combined basis for the investor to understand what the InvIT would look like with the assets. And this is important because when the SEBI provides the approval for the trust, at that stage the assets are not transferred to the trust. The assets are transferred to the trust only at the time when you know that you're going to do an offer, whether it's a private offer or a public offer. Just around that time, you actually execute the agreement for transfer of those assets, and within a few days, you issue the units both to the sponsor and to the investors. The reason why this has been done in this way is because what we understand is that the income tax department gave a view to SEBI that they did not want InvITs sponsors to transfer assets to an InvITs, and the InvIT never issued units or issued units but did not carry on the work of an InvIT, as it were. So to avoid that situation, SEBI approval for an InvIT requires that the transfer of assets and the issuance of units happens parallelly. So from that perspective, you can't have an InvIT taking on the benefit of the tax deferrals and not undertaking the object of being an InvIT going forward. So I will not get into any other detail on the disclosures. I will get on to the next bit on InvIT taxability, and there have been certain important changes on account of the Finance Bill of 2020. So just moving on to the next slide, we've put a table together for you. So from an SPV perspective, of course, at the asset level, corporate profit is taxed at 25% to between 25% and 30%. From a dividend payment perspective, there is, of course, after the introduction of DDT being taken away, right? There is no DDT that is payable. There is no tax on dividend that is payable, but a withholding of 10% is required. But this withholding is not required if InvIT obtains a tax deduction. Similarly, at the InvIT level also, there is no payment on dividend distribution, and the 10% rule which I just spoke of applies there as well. InvIT also does not pay any tax on interest income coming in from the SPV. What we are seeing largely is that InvITs are funneling down cash into the SPVs through NCD structures, and accordingly money moving upwards both through dividend and interest income. So again, from an interest income perspective at the InvIT level, there is no interest income, there is no tax interest payable. From a dividend income perspective, as I mentioned already, when the dividend is being upstreamed, there is no DDT payable. Only 10% is required to be withheld if there is no tax deduction certificate available. From a investor perspective, right? the important thing to understand over here is that the underlying income stream for the SPV and for the InvIT, and what the cash that the investor receives, the underlying income stream remains the same. So, for example, if the InvIT has received cash from the SPV in terms of interest and dividend, and it upstreams that cash to the investor then is also taxed on that cash that he has received in the same proportion of interest and dividend. So from that perspective, for a resident investor, interest income and dividend income is taxed at ordinary rates. For non-resident investors, interest income is taxed at 5%, dividend income at 20%. And of course, from a capital gains perspective, the resident investors are taxed at 10% for greater than 36-month holding and 15% for less than 36-month holding. Again, for unlisted InvITs, it's 20% for more than 36 months and 30% for less than 36 months. Or off-market transactions for resident investors, it's 20 for long-term and 30% for short-term. For non-resident investors, it's essentially the same for on-market transactions. For off-market transactions, it's 10% for long-term and 40% for short-term. For unlisted units, it's 10% for long-term and 40% for short-term. And with that, we will conclude our speaking session on the overview of the InvIT regime. And we are happy to take questions from you at this time. Thank you. Any questions from the audience? Rajiv, do you want to add anything to our presentation?
Sure. I mean, while we have covered the overall overview of the regime, and we have also covered more specifically the borrowings and the borrowings avenue for the banks. There are of course security structuring concerns when it comes to financing for InvITs, which is also to be taken into mind when considering financing. While the InvIT regime allows you to create security on the SPVs and the underlying assets, there are certain lock-in restrictions which come into effect when you're considering creating security on the shares which the InvITs is holding in the SPVs, as there is a lock-in period prescribed for 3 years. If there's any security considered to be provided on the units as well, there are restrictions there as well. So there are some security concerns as well which need to be considered while offering debt by the banks or by the NCD holders to the InvITs. So these are the concerns which need to be considered. Otherwise, there is of course a great avenue which is available for banks to park funds in infrastructure assets through InvITs. Are there any questions from the audience?
I think if you would request the audience to, there's a chat box that you will see on your screen. If you can put your questions there, that will be helpful. We can then pick it up from there. So the first question that I can see over here is that are there any discussions regarding guidelines for private unlisted REIT as well? Yes, there are discussions that are on for private unlisted REIT as well. The regulator has, when the REIT regulations came out, as you know, the only method in which you could get REITs listed was through a public offer. The concept of privately placed REITs did not exist or does not exist, and there has been strong resistance from the regulator at that point. But what I can tell you is that based on our information, the regulator is looking at private placement regime also to REITs. Whether we will have unlisted REITs, private unlisted REITs, that we are not sure as of now. But we are hoping that we will see a private listed REIT regime coming. I don't know when, but hopefully sometime this year. The discussions are ongoing at SEBI. InvITs have not been popular. Why? So InvITs have been popular. At least our take from the market is that InvIT, or whether it's a REIT or InvIT as a product, has not been communicated well to the investment populace at large, because essentially InvIT is an yield product, and one has to carefully. It's a complex product because you're looking at valuation models, you're looking at projection models to arrive at what will be the REIT pricing, etc. And then essentially it's a product it's a product for the long term. It's a hybrid instrument in that sense. It's not really equity. It does not move the way in which equity does. So from that perspective, I think, and you see, it's not found traction with the public investors, which is essentially retail investors. We've had only two public InvITs, which is essentially IRB and Sterilites Integrate, right? And both those cases, public did invest, but again, because they did not looking at same kind of returns as equity, it did not perhaps take off that well from a public offer perspective. But then we've had a number of privately placed InvITs, which are essentially open only to institutional players, and that has seen a fair amount of investment and interest, which is essentially whether it's an L&T, whether it's a Brookfield Gas pipeline. So from that perspective, and the privately placed listed InvITs became the vogue, as it were. And given that now the regulator has allowed private unlisted InvITs, that may also open up another avenue for various sponsors and investors. But for InvITs to become popular with the public in India, the retail or the HNIs, I think that will take some more time, and that requires a product education more than anything else. So the next question that I can see is that, which says this is in relation to the 90% cash flow upstreaming formula. What happens in InvIT has not received revenue, say like in renewable projects which are facing difficulties? That's a good question, and we've seen this even in road concession projects, right? For some of the road concession projects, what we have seen is whatever cash flow has been coming in, what the InvIT has done in that case is actually started returning largely the principal to the unit holders. So it's not been much of an yield play for them at that point. So essentially, we are looking at a cash flow scenario, right, rather than a revenue scenario. You have to upstream at least 90% of your not net distributable cash flow. So from that perspective, in a scenario where you may not have the adequate revenue, but you still have cash flow, to that extent, based on the SEBI formula, you'll have to upstream that cash flow. And in certain cases, when you get into difficulties, as a couple of road concession projects did, they started upstreaming the principal. And so it was not really becoming an yield play for the unit holders there. And that could be one of the other reasons why InvIT, when it started off, was not that popular. Do we have any more questions coming in? Again, just to reiterate, you can type in your questions at the question box, which is next to the screen. And if there are any questions that we are unable to respond to you or which come in later, we will definitely send a response over email to you. One question is, do investors classify InvITs as debt or equity investments? Or in another way, do InvITs attract debt investors or equity investors, especially public market InvITs? Right. So from this perspective, SEBI itself, if you see, has brought the equity model in terms of funding, in terms of various processes which are largely akin to equity. But within the SEBI structure, it is a hybrid product. And what at least the privately placed InvITs that we have worked on, we have seen largely institutional investors come in who are from a sponsor perspective, they are global asset managers like Brookfield, or pension funds like CPPIB. So from that perspective, I wouldn't say that you're only looking, you can't really bucket them into whether you are a debt investor or whether you're an equity investor. I think it depends on what the objective of your investment is. I think if the objective of your investment is a long investment where you're looking at regular yield, which is what pension funds are essentially looking for, which are what sometimes the global asset managers are looking for, then InvIT and REITs are fairly good products when you want that kind of cash flow to come into play on a regular basis. So I wouldn't categorize as debt equity. I would classify it as an investment objective. Why you're investing in a product such as a REIT or InvIT? What is your rationale for investment? If you need steady cash flow coming in at 9%, 10%, if you're lucky, then maybe an InvIT product is good for you.
So if you have any further questions, you can write to either Abhimanyu or me, and our email IDs have been provided in the presentation. You can always send out questions to us.
I also think there's a short. Sorry, one second. I believe there is a short poll for you because we like to take feedback on this webinar. So we will put out a short poll on your screen now. The poll will be available on your screen for about 15 seconds, and you can select an option by clicking it. And as you take the poll, I would also like to inform you that when you close this webinar, a short survey will open in your browser. We'll be very grateful if you fill that too. We take our audience feedback on our webinars very seriously. Though we prefer visual webinars under these trying circumstances, we are trying to test out our audio webinar capabilities. And to that extent, we'd be very grateful if you can give us the right feedback so we can improve ourselves at the next opportunity. And from that perspective, that will be very helpful. So I believe the poll is now closed. Thank you very much for your feedback. And thank you again for taking the time to attend today. As Rajiv mentioned, our contact details are on your screen. Please feel free to contact us if you have any questions about the topics discussed in this webinar, or if you have any questions that you couldn't put up into the box. We'd be more than happy to address it for you over email. The PPT and the recording of this webinar will be sent to you. So it'll give us some time as we are working from home now. So the team will take some time to process the recording. So you will get it within a day or two, but it will be with you soon. And with that, thank you very much again for joining us on this webinar in these trying circumstances. We at Khaitan wish you well. Stay safe, stay healthy, and stay at home. Thank you.